Welcome to another edition of Global Tax Talks. I'm Edwin Visser, I'm Deputy Global Tax Policy Leader for PwC, based in Amsterdam in the Netherlands. I'm here with two colleagues. To my left, Keetie van der Torre, Director Tax Policy in the Netherlands, based in Amsterdam. And also here with us is Chloe Fox, Director in Dublin and driver for the Global Tax Policy team. Welcome.
Thanks. Good to be here.
Today we're going to talk about a few high-level trends in the European Union affecting multinational companies, so affecting you. It's an interesting time in the European Union. The Council of the European Union just changed presidency, so we have had we had Belgium as a president for the first half year. Now we have the Hungarian presidency, and of course we just had elections for the European Parliament. So we'll have a new commission during the next 3 to 4 months, and so we have to wait and see what the new mandate of the new commission will be. So a bit of uncertainty on the agenda at this time, but I think we can still share some trends. The first one is for you, Keetie, and that's one we're seeing worldwide, I think, and in expanding reporting requirements for companies. Increasing compliance burdens, I would say. That's not only due to the sheer number of new obligations, Pillar 2 for example, CSRD, but also to the increasing complexity of those rules and their interdependency. So Keetie, could you share some examples please of the initiatives of the EU that companies must address and how they could meet those challenges?
Yeah, thanks, Edwin, and happy to share my thoughts about that. I'm not going to discuss all the things what's going on in the EU, but I think we can relatively focus on adopted legislation. And the first thing is Pillar 2. It's already adopted in a directive, implemented in national legislation. And what we see is that both companies and tax authorities are executing the Pillar 2 rules. And the OECD is releasing more and more guidance, so complexity is really increasing. So it's a real challenge for companies to be compliant. So that's the first thing they want to do, to be compliant with the rules, and that's really a challenge. So another thing what we see is the foreign subsidies regulation. And the foreign subsidy regulation is EU legislation which was aiming at expanding the EU state aid rules. And it is also very complex because it obliges companies to notify very many data, explicitly when it comes to mergers, acquisitions, joint ventures within the EU. And they're really concerning about gathering all those data. So they see that they have to do the notification to the European Commission, and not only tax data, so that is a real challenge for companies to comply with those rules as well.
Expanding, but in fact you say it's exporting the state aid rules to countries outside the EU?
Yeah, to third countries. So if there, for example, a subsidy or a financial contribution granted by the US, for example, then it affects the European companies, head of branches in the European Union as well. So that is a little bit the expanding of the EU state aid rules. So better pay attention
because the consequences can be really dramatic if you don't comply
if you miss
and
it.
fall in scope. Yeah,
absolutely, because the power of the European Commission is very far-reaching. So they can have penalties and fines, but also oblige companies to be not longer present at the European market. So please be aware of those rules. So let's move to the CSRD, the Corporate Sustainability Reporting Directive. Also very an important directive, obliging companies to report on ESG issues. And at the heart of the CSRD, there are the European Sustainability Reporting standards. And from a tax perspective, you can't see a standalone ESRS. But there are many links with tax in the CSRD and the ESRSs.
What is an ESRS for the audience, maybe?
It's a European Reporting Sustainability Standard, and it covers the E, the S, and the G. So there are a lot of disclosures, and it is all focusing on environmental, social, and governance aspects. And it is very important to be aware that limited assurance should be provided on those disclosures. So that's also a real challenge for companies to be compliant with the CSRD. Well, another piece of legislation which is already in place is the Public Country-by-Country Reporting Directive. And that's also very interesting because we're already familiar with CBCR, but not the public aspect. So that means that tax reporting, like profit taxes, are now in the public area. So that is very interesting, and we see that clients are dealing with those rules, but also looking at exemptions and dealing what if, for example, a parent entity is not able to provide the data when a parent entity is outside the EU. So very complex rules, but again, very important to be compliant with.
It's also important, I think, to prepare for the narrative around the data, because the data can be complex and confusing maybe, but so do you advise that to clients also to prepare for a narrative around the data?
Absolutely, because only the amount in the figures is not enough. You really have to provide a narrative. For example, your ETR could be very low because of the application of tax incentives, and that could be a very good story. Yeah. And of course, there is also a link with Pillar 2 for the safe harbors, so it's really important to pay attention to those rules. Last thing I would mention is the CBAM, the Carbon Border Adjustment Mechanism. And that's also a very tough piece of legislation. We're now in the transition phase towards 2025. And 2026 it will be the final version. And companies, the CBAM is a piece of the whole green transition within the European Union. And it provides companies who are importing products with carbon emission, with tariffs and charges. They also have to notify those things to the customs. So very important for companies as well. So very, very many administrative burden. So that is already legislation what is in place. And of course, there is future legislation. There are discussions going on. And the only thing I want to mention in that perspective is the Unshell initiative. Mm-hmm. And the Unshell initiative could also be a potential exchange of information between tax authorities and the introduction, for example, for a standard for substance. But it is really under discussion, so we are not there yet. But it's good to bear in mind that it could also raise administrative burdens for companies. And then you can absolutely raise the question, so how are they going to deal with all those administrative application and requirements? What we see is that tax departments really raise fundamental questions to itself. So what about the future of our tax function? Mm-hmm. So they're really reimagining their function. And what you can see is that because of all those administrative obligations, they're looking at the possibilities of Gen AI, outsourcing, for example, services. So really interesting questions to be raised on this case.
Thanks, Keetie. Quite a challenge, I would say, and that's an understatement, to gather all this data, to interpret all the data, get them ready for all the reporting requirements. That is absolutely really serious. And as you say, it is enacted, so
it's already in place.
You need to get an action. That's what you're saying. Yeah. Now, turning to you, Chloe. We talked about compliance burdens and complexity, but there's also an ambition at the Commission level to come up with legislation that is business-friendly, reduces complexity. Can you tell us a bit more about those initiatives, please?
Yeah, absolutely. And the Commission has released a number of different proposals recently to try and really help with easing the administrative burden of the overall tax compliance landscape, I suppose. The newer proposals, they do tend to have a more specific focus, so they focus on particular areas, and I'll go through a couple of examples of what we're seeing here. So the first is the FASTER, so that's the faster and safer relief of excess withholding taxes. And the idea of this proposal is to try and encourage more investment into the single market by simplifying and making more effective the procedures around EU withholding taxes. There will be some new obligations with FASTER for financial intermediaries and also tax administrations. But I think the FASTER proposal is probably the one that's most likely to move forward, given that it's already received the EU Council unanimous approval, and it's just awaiting the final approval now from the EU Parliament. The next proposal then is the BEFIT, so it's the Business in Europe Framework for Income Taxation. And the idea with this proposal is it's designed to try and streamline the calculation of the tax base for companies that are based in the EU. In its current guise, I think it will be difficult for BIFA to try and get unanimous approval at council level, just given some ongoing issues around its timing and also the lack of alignment with Pillar 2. So not quite so sure on the BIFA one just yet.
Quite carefully analysis try and reach a common tax base. Personally, I'm quite skeptical about it, but
yeah, and I think that's what will.
yeah.
I think that's what will come out when the member states start to actually get into their proper discussions about what are the pros and cons of BFIT. Can it achieve what it sets out to achieve? So we'll see. I think over the next few months where that goes.
There's one element in BFIT I think that could be interesting for business. That's a really harmonized common corporate tax base. And of course we have seen that before. It was called the CCTB. That failed. So what do you think about a harmonized common corporate tax base? Would that help business?
I think one of the main challenges at the moment with BFIT is that the business community doesn't necessarily see it as a simplification. I think what we're seeing at the moment is that it actually looks, in its current guise, it looks to make compliance more rather than less difficult, especially just in the transition period. So I think that's another major hurdle that will have to be overcome.
Yeah, and the timing is also unlucky. I think, we don't know the effects of Pillar 2 yet. So that's, I think, something you need to wait for before we start adding new rules to the already very complex rule book of the European Union.
Yeah.
But there's more perceived
simplification,
I think.
I think so, yeah. I think that's a fair statement. There are some other proposals as well that do have the objective of trying to simplify or harmonise the EU tax system. So one of which is the transfer pricing proposal. And the idea there is that would incorporate the arm's length principle and also some other transfer pricing rules into EU law. And that's to try and, I suppose, harmonise both the status and the application of the OECD transfer pricing guidelines across the EU member states. Now, again, there is a risk here that this might seem like a second transfer pricing standard that the member states would have to introduce. So that's another challenge that will have to be overcome. It makes it look a little bit unlikely at this stage that we might get there. And then the final proposal I just wanted to mention was the head office taxation, or the HOT proposal. So that's a system that would allow small and medium-sized enterprises to effectively calculate the tax computation for permanent establishments in the head office or the main entity location. So here you're talking about, filing, compliance, payment of taxes. That would all take place in the main entity location, which I think would be helpful. So those, I think, are the key proposals that the EU Commission has published. Also, I suppose what we're seeing is that the Commission is also looking back at some of the proposals that have already been legislated, many of which Keetie has gone through already. So we've seen already that they've opened an evaluation on the Directive of Administrative Cooperation, or the DAC, and also we expect that they will evaluate the Anti-Tax Avoidance Directive over the next few months. So, really I think a key area to watch, and hopefully there's something in there for the business community to take as a glimmer of hope that the tax compliance environment might be simplified at least a little.
And there's a new buzzword floating around in Brussels, I think, and that's called decluttering.
Yes.
Can you spend a few words on that, please, Chloe?
Yeah, absolutely. And I think we'll hear a lot more about this over the next few months. And this is really, directly in response to the calls from the business community to try and ease that administrative burden that they're really suffering from, especially in light of the introduction of Pillar 2, bearing in mind CSRD, FSR, etc. So again, like I said, we're re-evaluating the DAC. We're hopefully going to look at the Anti-Tax Avoidance Directive. I think that will help. But I think this overall conversation about decluttering, trying to make the tax rules more simple, more streamlined, make them work on a more harmonised basis across the EU member states. I think especially going into the new EU Commission term, given that we understand that they're going to focus on competitiveness, I think decluttering is a term that we'll hear about not just at EU level, but also from an OECD perspective and across the globe a lot more over the next year.
Could you give an example? I hear that CFC could be part of that decluttering. Do you need CFC rules when you have a minimum tax? Are there more examples that you could mention, without giving hope, of course, because it's a very complex process?
Yeah, I think there's lots of examples now. To what extent the EU Commission would take them on board, I think, is a different story. Another one that I've heard is the interest limitation rules, whether or not, again, given Pillar 2, which effectively covers a lot of the same ground, I think interest limitation is one that people might like to see simplified to a certain extent, but there's lots of there's lots of rumours about what might be covered, but very little concrete evidence at the moment.
Thanks, Chloe.
Okay, no problem. Actually, just maybe to take a little step back, I suppose, there's obviously a myriad of different tax policy trends that we could talk about, and this is a very short and a very high level discussion. But I think one of the topics that may be worth thinking about a little bit more is just that push and pull between the member states to, on the one hand, try and generate new tax revenues, but also to try and remain attractive for investment. And Edwin, maybe could you give us some examples of why this tension has taken centre stage, and also what are the companies' response to this tension?
Yeah, that's a good question, and a complex area, I think, and I'd like to take a little step back and give a broader perspective. I think there's a growing realization in the European Union that the EU is lagging behind when it comes to economic growth, productivity and technology. There's also the realization caused by COVID, the war in Ukraine, for example, that we need to be more autonomous from a strategic perspective. We don't want to end up in a situation again that we cannot produce our own vaccines when there's not a pandemic, for example. We don't have our own defense industry. We don't have our own chips industry in the European Union. So that is one, I think, and one of the big topics for the new Commission, and you said it already, Chloe, will be competitiveness. How can we better compete with China, US, and other economic blocs in the world? And when you ask, will this lead to tax incentives at European level? Well, I don't think so. The European Union doesn't have the competency to do that. The competency to provide tax incentives is with the member states, and that will stay with the member states unless the EU treaty is changed, but that's not very likely. And then to your point, for many years, countries have been introducing tax incentives to pursue a wide array of economic objectives. Investment, for example, and you see many forms. Accelerated depreciation is a very known one, but R&D credits are another one, patent boxes, etc. But I think, the tax landscape has evolved in such a way that those tax incentives need a rethink. And Pillar 2 is a trigger to do that, I think. Pillar 2 makes a distinction between refundable and non-refundable tax credits. So the non-refundable ones are treated less favorably under Pillar 2 than the refundable ones. So countries will have to rethink their tax incentives, their current ones also, in the light of Pillar 2. What you also see as development is that some countries, and the most used example is the US, I think, with the Inflation Reduction Act, introduce massive subsidy programs via the tax system. So that creates a realization for companies, but also for member states, to say, well, how about our tax incentives for the future? And when you look at the horizon, it's not easy to predict how that will exactly evolve. The tax incentive landscape will change, I think, for sure. Where it will be heading is not that straightforward, I would say. But for the tax function in the company, it's very important, I think, to keep track of all those developments. What's going to happen to the tax incentives? How is the EU going to react to the Inflation Reduction Act? What role does FSR, the Foreign Subsidies Regulation, play in this? And they need to do that to keep their boards informed, because ultimately they take the decisions where to invest and where to do business. So this is a very important element for that. Does it answer your question?
Yeah, it does. Thank you very much.
Is there anything you want to add, Keetie, maybe to the discussion?
No, I think it's a very interesting time to track all the tax policy developments, especially after the European elections, with the new Commission coming and a new mandate.
Yeah.
It's an interesting time, I think.
Thank you both for sharing your perspectives, and be sure to listen to our Global Tax talks, also to the 60 Seconds by Will Morris. Stay tuned so that you can be global tax ready. Thank you very much.